following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It is a dangerous world out there. Volatility is on the rise and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews with leading advisors, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. And now, it's time to arm yourself with the latest weapons in the war on risk. It's time for the Advisor's Option.
All right, and welcome back to the Advisor's Option. Of course, this is the program where we educate financial advisors and asset managers about the risk management aspects of options and how to implement these products in your portfolios out there. And I know a lot of you have been excited, looking forward to the next episode. We've been on a bit of a hiatus, but now we're back. And we're ready to go with new episodes of the Advisor's Option. My name is Mark Longo from the OptionsInsider.com, as well as the old Options Insider Radio Network. I'm pleased to be joined on this revamped Advisor's Options panel by some new co-hosts, some new panelists, starting off with, you may remember him from a previous show. He liked it so much, he just had to come back. He is Randy Swan, the co-founder of Swan Wealth Advisors. Randy, welcome to the program.
Thank you very much, Mark. It's a pleasure to be on the show.
I think last time we spoke, we had you on down at the OIC conference talking about some of the overlap between the Options Industry Conference and the Advisor Show they had going on at the same time. But now we're happy to get you on the show on a more regular basis so we can have you chime in for some of our listeners and give some of your analysis and advice about how advisors should be using these products. We're also joined on the old panel today by my cohort, my partner in crime from many shows here on the old Options Insider Radio Network, and we're pleased to have him making his return to Advisor's Option. He is none other than good old Mike Cavanaugh from Know Your Options Inc. /RCM. Good old Mr. Mike, welcome back to the show.
Yes, sir. It's great to be back, Randy. It's good to be back, reacquainted with you. We did the show down in the I think that was one of the inaugural shows down in New Orleans at the OIC conference. So it's good to reconnect with everybody on the show.
Definitely, it was a good time in New Orleans, and no more humidity up here in Durango right now.
Well, you don't want humidity. Chicago right now and going into December is probably the place to be. We're not exactly tropical over here. But yeah, we also hope to be joined by some people from the OIC in a little bit. But right now, with the panel assembled, we're going to dive right into our Options 101 segment.
It's time to learn how to manage risk and generate additional income for your clients. It's time for Options 101.
All right, and welcome to our Options 101 segment. This is, of course, where we educate you, the busy advisor and asset manager, about some interesting options topics and products and strategies that you may find useful in your own practice and for your own client accounts. And if you've been listening to this show for any length of time, you know we've been laying out a number of different basic strategies. And these, of course, have run the gamut from buying a call to buying a long put to protect your underlying long stock position. And in a recent show, we even talked about writing a covered call to generate some income from that long stock position. But in today's episode, we're going to talk about, in many ways, I guess the ultimate advisor option strategy. Is called the collar. And what this strategy does is it really combines some of the aspects we've discussed on earlier shows and combines them into one superstar strategy, if you will. When we're talking about a collar, we're talking about a long stock position that is hedged with a long put position and then is indeed financed by a covered call position, all wrapped up into one nice, neat little package. And when we talk about collars, this really seems to have a lot of resonance with advisors. All the advisors I've talked to over the years really seem to gravitate towards the collar for a number of reasons. Many of them are primarily long equity traders. They have a lot of long stock positions in their accounts. So they're looking for hedging and risk management. Anyway, this is a great way to finance that hedging and risk management. And if it's done well, you can even add some overall points of return to your portfolio. And to help us talk about collars today, we're bringing in the man who has all the studies. He is Alan Grigoletto, the Director of Education over at the Options Industry Council. Alan, welcome back to the program.
Well, thank you, Mark. It's a pleasure to be on again with you and with our esteemed guests. The collar is actually two strategies in one, as you pointed out. It's a covered call, but also a protective put. And these strategies are very, very popular, especially for holders of concentrated stock positions. And by that, I mean any client who might have a large portion of their assets tied up in a single equity and therefore has a lot of risk should that equity drop in price. So a collar kind of gives you the opportunity to expose yourself a little bit to the upside by setting a cap above the market price of the stock, but at the same time gives you some of the protection of the downside. And typically speaking, the simple example would be to use a call option that's equal to the put option, and hopefully you can do it for a zero cost. But in many cases, because of puts in a volatile market will carry a larger premium, you may want to skew that and use a further out-of-the-money put. So it's a terrific strategy. We know lots of advisors that are using and employing this strategy. It works really well if the holder of this concentrated position is also an officer of a firm, a publicly traded company who does not want to sell his stock at this particular point in time, but at the same time wants to make sure he protects it against any shocks in the market like the fiscal cliff.
Ah, the good old fiscal cliff. But I know you guys over at OIC have done a lot of great research on the collars. I want to get to that in a second. Before we do that, I want to get into some of our other panelists here to see what they have to say on the collars. And Mike, one of the reasons I wanted to have you on the show today is I know the collar is one of your go-to strategies over there at KYO and RCM. In fact, I'd go out on a limb and say the majority of your client accounts probably have a collar in there in some way, shape, or form. Am I correct?
That is correct. And the way we basically use the collar is to say, the typical traditional wealth manager or advisor, they're not telling untruths. That if you put money into the market, you should expect more money at the time you start withdrawing the money from the market. What they don't tell you is how emotional and volatile the swings in the market can be. And what you find out is that there's a behavioral part of finance that when you see the market down 35%, and you call your advisor and you don't get an immediate answer on what's going on, there's a panic. There's an emotional decision that's usually triggered when that happens. And anytime emotion gets mixed with financial decisions, the outcomes are usually undesirable. So basically, the way we view a collar is it helps take the volatility out of a return in the equity markets. It smooths out the volatility. We don't use any leverage in collars. We just simply say, look, when the market's going up, you're not going to make as much as the market. When the market goes down, you're not going to lose as much. And when it stays flat, you're probably going to make a little bit more. And we're just going to hold the underlying forever and adjust the option position around the movements. And it's not rocket science, but it definitely, like Alan was mentioning, in times of uncertainty, it almost becomes somewhat of a safe harbor to know that you have a floor and a ceiling on an investment, which really has never been discussed in the traditional wealth management capacity. You know, what's usually discussed in the traditional wealth management capacity is how much money you're going to make. Nobody wants to talk about losing money or what the risks are. It doesn't duck the hard conversation of, okay, if I invest money in the stock market, how much could I lose? Well, if you're concerned about losses, let's talk about that. Here's a way that we can limit the losses by purchasing a put and helping finance the purchase of that put by capping our upside. So your assumption was right, Mr. Longo. We do use some collars from time to time.
I went out on a limb on that one. That was a big guess, big risk on my part. Now, Randy, you guys over at Swan do something a little bit different. You guys do a lot of different volatility and different types of overlays for your portfolios over there and for your mutual fund. Do you guys ever get a chance to implement some collars over there, and what's your general take on this overall strategy?
Well, first of all, I love the collar as a strategy, especially in today's interest rate environment where it's very difficult to earn any real return on bonds. So I love the collar as a basic strategy to maybe replace some of the fixed income. But beyond that, our basic strategy, we add one component to the basic collar strategy in that we also sell out of the money puts against our long-term puts that we use to protect our equity. So I would say it's more of a collar plus strategy or a hedged equity plus option income strategy. So it's been a good strategy. It's been a great strategy for us over the years. We've been implementing a similar type strategy since 1997. So I think in this market environment, with all the uncertainty out there and the issues with what's going on in the world markets and economies around the world, there is probably not a better strategy right now if you believe somewhat like I do that the market's not going to continue to go straight up forever.
I like that, collar plus. If you're not already using that in your marketing, I think you should adopt that immediately. That's a good one.
Thank you.
But essentially what you're doing for our listeners out there is you're taking that long put and you're turning it into essentially a put spread. So you're mitigating even further the premium outlay you have on a strategy like that. And of course, when you're talking about collars, premium is the name of the game. Like Alan said earlier, a lot of advisors like to go out and do zero cost collars, so their net outlay is zero on the trade. They're getting this protection for effectively nothing. I'm sure Randy's strategy of the collar plus makes that even easier to do because you now have two essentially income streams to offset that long put position. Of course, you're mitigating some of the downside as well, but as long as you're not expecting the overused cliche of the black swan event, you should be all right, I think, in most scenarios.
Well, we get asked a lot about that, and I always tell people I like selling the out-of-the-money put. Of course, we actively manage those, so we don't let the put options ever go in the money if we can help it. But I always tell people the puts with the volatility skews on the downside is you go out there because that's where the money is. That's where historically a lot of our profit from our strategy has been from, is not only selling the covered call but also selling a put spread. And of course, you're dealing in our strategy with different time horizons where you're buying a longer term put, typically a 1 to 2 year put, and then selling short term options. So you've got some theta working for you as well.
Yes, and when you're selling,
that's a great strategy, Randy. And in fact, in the study that we did with the University of Massachusetts, we employed a 6-month put collar and a 1-month rolling option on the call side. So protection was bought twice a year while you're rolling the monthly options. And that seemed to work very, very well and gave a little bit of outperformance without having to buy the insurance over and over again.
You know, it's interesting, Alan. Let's hit on that for a second then, because like I said at the top of the show, you're the man with the data. And the traditional knock against collars. I'm sure you've gotten this pushback from a lot of advisors. We've certainly heard this from a lot of our readers on the Options Insider, and then, of course, listeners to these shows, that, yeah, I like the collar. Once they get a little bit more savvy in options, they understand how it works, they start to worry about it clipping the upside. So the natural pushback against the collar that we hear is, of course, oh, if I put on these collars, I'm paying all this premium or maybe zero cost for this protection. I'm clipping my upside at the same time. I'm going to dramatically underperform my peers who are just naked long only. And so what you guys over there at the OIC have done is some really interesting studies on collaring the Qs versus owning it naked outright. And like you said, you constructed a very interesting collar, taking advantage of time decay and things like that to put the 6-month put with the front month call. And why don't you tell our listeners about some of the findings you've had from those studies? Because I think they're very surprising.
Well, we've done it on several products, Mark. We've not only done it on the Qs, we did it on multi-assets. There were 15 different underlying assets. And as you might imagine, in choosing the assets, we also chose some of the more recent products, gold and silver. And because those particular commodities went straight up in value, the collar actually underperformed in those types of marketplaces, as you might imagine, because there wasn't a lot of reversion to the mean, there wasn't a lot of pullback, and assignment risk on that call was very prevalent in stocks like that go straight up. However, in the clear across the other cases, the collar outperformed the naked hold of those underlying products on a risk-based return basis, meaning you reduce the risk, so your risk-based return versus holding that underlying equity naked was much better return. And I think if you're a portfolio manager and you employ a collar, one of the things you pay most attention to is, Sharpe ratios and the like, and how much risk you have to a portfolio. We have a study on our website. It's available to anybody who wants to come to optionseducation.org, and they can download the summary statistics on both the QQQ and the 15 underlying assets that we just completed last year with the help of University of Massachusetts.
I think that's a great point, is that on a risk-adjusted basis, the collar is certainly an outstanding, home run. Of course, there are some scenarios where it is going to underperform, like in that environment you just mentioned in the metals where they shot straight up. And that's probably the one real scenario where you're going to feel that clipping of the upside a bit, and that's going to clip some of your returns. But I think the surprising thing for me when I first started reading your studies, and you've been doing these studies for years now and updating them time and again, is that the collar, outside of those outlier scenarios where the underlying essentially went straight up, the collar certainly outperformed on a risk-adjusted basis. Because remember, listeners, when you're looking at a collar, you have that long put position as well as some offsetting short positions, depending if you're just doing the collar or if you're just doing maybe the collar plus, like Randy was talking about, where you have two positions. But you're generally going to be net long volatility, which is nice because that gives you some exposure to one of the true uncorrelated, or inversely correlated, I should say, asset classes out there, which is a great thing for a long equity holder. But that also is going to mitigate your volatility of your portfolio as a whole. So from a risk-adjusted basis, you're really going to outperform. But what even surprised me even more, Alan, was that, like we said, aside from those crazy outlier scenarios, the collars on a pure return basis were also competitive.
On a total return basis, it also outperformed in many, many cases.
That to me is stunning.
Many cases.
Because I think a lot of your advisors are going to push back and say, well, I need something that generates me return, total overall return, and I don't want risk adjusted or whatever. Perhaps they just want pure naked return to turn around and sell to their clients. So if you can tell them you have a strategy now that mitigates your risk, mitigates your fluctuations in the underlying, and also is competitive, if not outperforming on a pure return basis, that to me is a home run.
And if you think about it, Mark, if you look back over the last 10 years of the marketplace, we're really back where we were in the 2002 range. We really haven't moved that much. I mean, we've gone up and we've gone down, but we haven't exceeded those highs that we made 10 years ago. And if you can imagine just selling call options, perpetually selling call options over that period and garnering income, you can easily visualize how that would outperform just a simple buy-hold strategy.
This is Randy. I wouldn't look at the strategy as in lieu of a long equity strategy. It could be used very effectively as in addition or replacing other types of asset classes in your portfolio. So even if you make the argument that during some time periods where the market is going up rather quickly, what about just adding that as in addition to other things you're doing? And so they're not necessarily competitive with each other. They're complementary. So if you were going to normally have, let's say, a 60-40 stock bond mix, maybe allocating 20% of your bond or 50% of your bonds or 20% of the portfolio to a covered call or this type of strategy, a collar strategy, would be a great incremental benefit to the portfolio.
That's true. You don't have to go out and go whole hog and collar your entire portfolio. If you are concerned about this or want to test the waters before you go full bore into the strategy, that's a great idea. Take some of the assets you have allocated to other relatively underperforming segments right now, like fixed income, take some of that and put it into this strategy where you can allocate it on a fixed return type of basis and fixed volatility exposure basis. And that really is, I think, an interesting scenario. And speaking about what you're talking about there, Randy, the collar it comes in many different sizes and shapes and indeed flavors out there. So when we're talking about collars, maybe we should just clarify exactly what we're talking about here for the listeners, because we've already bandied about a bunch of different concepts. The typical collar, like Alan referred to earlier, a lot of advisors struggle to make these zero-cost collars, and that usually implies writing the call and buying the put in the same month, because that's where the premiums tend to usually work out the best, and you can offset them or close to it and make this zero cost outlay. And they're entirely fixated on cost and premium, which is not entirely, it's understandable, even though it's not entirely perhaps the ultimate way to structure your collar. Now you can start tweaking these collars to get a little bit more effective and taking advantage of some of the topics we've discussed on earlier shows. Remember our options basics conversation talking about Greeks, talking about things like Vega and indeed theta. Remember when we're talking about theta, which is time decay. When you're long options, theta is your enemy. When you're short options, theta is your friend. So when you're looking at the collar component, it really has a collar strategy. It has two components, the long option component and the short component. So in each of those, you want to try to attempt to maximize the theta. And that's another reason why I like what the OIC did, is because they took different approaches and they did indeed maximize that theta, rolling their long position from the front month out 6 months. So they delayed and really maximized their premium to theta ratio there in terms of what they were paying versus how much that option decayed. Where on the same tip, they turned around and wrote the front month option, which again, if you listen to our earlier episodes, remember writing very near-term, short-term options is an ideal way to maximize that exponential part of the theta, the decay curve. So if you're looking to construct your collars, something along the lines of what the OIC did with that optimal 6-month put and front month, or even if you're really, really aggressive weekly calls, things like that could really be excellent ways to tweak the strategy to add a little bit more bang for your buck. And then what Randy threw into the mix, I think, is also an interesting way to do that, which is adds an additional short premium component to the strategy, which is, of course, selling that downside put, turning that put into a put spread. And I joked with Randy about the black swan type event, but what he's saying is quite true in that, we've seen a lot of people writing extended treatises on this these days about that quote-unquote black swan and that type of tail risk in the marketplace. And the result of that has been, in a lot of people's eyes, including it sounds like yours, Randy, that tail risk is dramatically overpriced. So if you're looking at trading, collecting some additional premium, the downside of the put wing, those downside puts are really a great place to harvest some of that. And it sounds like, Randy, you found struck a good balance out there with that.
Absolutely, and I think the name of the game is risk management. We have a slightly different approach at Swan in terms of how we manage the trades, but we always look at I use the analogy of walking in the rain with an umbrella. We're always trying to bracket the market on the upside and downside, trying to let the market move within a normal range on a monthly or a quarterly basis, but it really gets back down to, yes, there is some exposure on the downside, but I think if you have some good risk management rules, you can really mitigate that risk. So,
what I think is really, really intelligent about Randy's the way he handles the collar. We see it a lot where you take a stock like Johnson & Johnson or Procter & Gamble or McDonald's, and you get in a collar, and the client looks at you like, well, I don't really think Procter & Gamble is going to go to zero. So it really allowed that Randy's strategy allows the client input to say, hey, or, at least the way they're looking at it is, we can collect some premium here on this stock because Procter & Gamble is probably not going to go to zero. We have the defined risk managed with the actual collar, but hey, maybe we can sell a little extra premium here. And I think it's also very smart that you buy the long dated puts and sell the upfront puts for the theta advantage as well. So it is an interesting spin on how to make a strategy even more beneficial. I mean, because the old saying that we live by is you can't get to second base with your foot on first. In order to get ahead in the market, you have to take on risk. And Randy hit the nail on the head that risk management is the key. You're not just guessing, throwing darts at the wall here. You're using an intuitive, formulaic method of investing to say, hey, we're willing to take on this risk because we understand it, and we're going to take the time to manage the risk that we understand. So I think it's very, very intelligent the way that you've added the short put in the front month to help defray the cost of the long put in the back month.
And to Randy's point, too, where he stated that it needn't have to be on the entire portfolio, it also needn't have to be on the entire holdings of a single underlying equity. You can do a portion of an equity holding. If you own 10,000 shares of a particular stock, in order to get a client accustomed to how this might work, you might only do it on 25% of that holding. Assignment risk is then proportional, I guess, to fixing a selling price above the market. And you can say, look, if you get assigned on this, we're just taking profits off the table on a quarter of your holdings. And one gentleman who was at an event in New York pointed out that, in today's environment, we're at all-time long-term capital gains tax lows. That might not be the case in the future. So at 15%, likely to go up to 22%, it's not such a bad thing, assignment risk, given the current climate.
No, people get afraid of having their stock called away, but in many scenarios, you should say that you should be elated at that. That's not a bad problem to have. It kind of gets back to some of that backwards viewpoint people have on options, where that actually is a good scenario. Mike, before we get away from the different structures, I think you have an interesting approach to kind of legging into collars, almost a rolling collar. I believe you've jokingly referred to it in the past as the wheel of fun or the triple income strategy, but you take another approach to some of the strategies we talked about on an earlier show, the short put, using the short put to leg into a long equity position, and then once you have the long equity position on, either writing the covered call or indeed fully collaring it and going from there. So it's taking kind of what Randy's doing, but doing it a little bit earlier and running the put first and then kind of going from there.
And you can do it. I mean, what you could do, and what we've done is we say, hey, what the fundamental analysis done is what stock do we want to own? And what price do we want to own it at? And can we make money waiting for the stock to come down and putting a limit order in? No. But we can make money waiting if the stock's trading at 50 and we're looking for a 10% decline in the stock of where we like it, we could sell the 45 put and collect a little premium on the put. We could enhance that and make it more like the Randy strategy there, which I think is, once again, intelligent. We could go out and buy a long dated put and then sell the front month put, and as soon as we get assigned, then sell the front month call. So what we haven't done that in the past, but what we've typically done is, and I call it the wheel of fun, is we sell the put as soon as it gets assigned. We sell the call. If we get called away, we sell the put the next month, and we make a quarterly assessment on, is this still a stock we want to own? What we've found is when you're wrong and you owned a binary return, meaning if I just bought the stock right now and a 10% decline happens, I'm taking on that much more risk. If the 10% decline happens on the put option, yeah, I'm gonna get hit, but I got paid to wait. And now if the stock goes back up, I'm going to collect the money on the call. So what we found is it helps us once again smooth out the volatility in the return. Even though you're using options, which most people equate to volatility and risk, it's actually something that helps you take the risk and the volatility out. And that's what we've been finding. And you're not going to make as much money, like Alan pointed out, on the individual, those 15 individual markets. if a stock goes linear and just starts going straight up, and you've got a collar on, you're not going to be able to keep up. But a stock that can go that fast and that far in an upward direction probably has the potential of going that far and that fast in the downward direction. That's where you have the people calling in saying, man, I wish I would have known about a collar then. So it really, truly, the effectiveness of it for us is smoothing out the volatility in the portfolio to keep those emotional decisions between client and advisor to affect the financial decisions.
But Alan, it's interesting. We talked about some of your studies. I know in the early days of the advisor initiative over there at OIC, when you went knocking on some of these advisor offices, their responses were probably mixed and, well, I don't like options or collars, this or that. But now when you knock on their doors or you call them up and you come armed with this collar data on these different studies, what are their responses like these days when you show up and say, here's some interesting data on collars? Do their eyes kind of just pop wide open at the sight of this kind of stuff?
I would tell you that in the past, we probably would be turned away from having any discussion about options with advisors. And this is just as recently as, 3 years ago. But as Randy pointed out, we're in such a low fixed income return marketplace right now, with rates at historical lows, that advisors are now seeking additional strategies where they can provide yield to their client. They have to be able to differentiate themselves from the advisor or the wealth manager down the street. And covered calls and collar strategies, once you grasp the concepts of it, are not that difficult. And the clients are very appreciative of the fact that you're providing them with a solution to not only their yield issues, but also to their anxiety level about the volatility in the marketplace. So it's been in the early days, we were knocking on their doors. Now they are knocking on ours for more information. So it's been a real pleasant undertaking for us over the last few years in reaching advisors and teaching them about options.
Our experience over the last several years has grown tremendously about how many advisors are even willing to consider strategies like this. And of course, we go back to them and say, you need to think outside the style box, because there's definitely, as we talked about earlier, there's new tools, there's new weapons to use against the risk and fixing some of the problems with the fixed income. So supplementing portfolios with options is obviously a great strategy.
It is amazing to me in this day and age still how much this data and this information has how far it has to go to penetrate into that asset manager and advisor community. I was at a very large mainstream asset manager and advisor conference not too long ago. I will leave the name out of it. You probably can guess what some of the big names are in this space. And I was talking to people who managed funds that were income funds or quote unquote volatility funds. I say, oh, income funds. This is the time of fractional interest rates. How are you generating income? Are you writing options? They say no, buying high yield names and the high dividend names and that sort of thing. And I'd see risk management volatility funds. I say, oh, are you using volatility products? Are you buying options, writing options? What are you doing? They say, oh no, we're doing defensive stock selection and that sort of thing. And so it is amazing how far this stuff has to go. And we're not talking, like we said, we're not talking rocket science here. I mean, it can obviously get as complicated as you want it to be, but the basic core element that we're talking about, the collar, is a relatively rudimentary strategy. If you understand long equity, you understand how to hedge it and some income aspects of that, you're 90% of the way there. So if you're an advisor who's long only, and the vast majority of you listening to this show are, this is certainly a strategy that is worth your consideration. In many ways, this is the point we've been building toward since we launched this show, talking about all the basic components of options, talking about buying puts and then selling puts and then writing calls and all these different elements. We can finally combine them into this one strategy that whenever we talk to advisors and they learn about collars, it seems to be this becomes their go-to strategy going forward. They find different ways to tweak it. Maybe they do what Randy does, maybe they do what Mike does, maybe they did what Alan did in his study and tweaking the setups in whichever way suits their strategy the best. But at the end of the day, this is their go-to strategy going forward. It just becomes a very, very meaningful and useful implementation of this very, very interesting trading strategy. So that's our overview of collars for you there, the listener. Before we close out this segment, Alan, what's next on the data front? Are you updating the collar strategy, or maybe going to throw weeklies into the mix to see how that impacts the returns? What's coming up over there?
Well, we haven't made a decision yet on what we'd like to explore. As you know, anytime a university does a study, you have to stand aside and let them. We provide them with the data, and then they provide the analysis. We can provide them with kind of the strategy, but to keep the data clean and to keep unbiased data, we allow the universities actually to run their scenarios on pricing. What I was thinking of is very similarly to what Randy was talking about, without the put spread, but just what we call a covered combo strategy, which is just owning the underlying equity, selling the call, and selling the put. So collecting two premiums and seeing what kind of results we would get from that if we did a very wide covered combo. So that's one of the things that we're toying about, but stay tuned.
All right, thank you for that, Alan. And that's going to do it for our Options 101 segment. Because we went on a little bit about collars, that's also going to do it for this episode of The Advisor's Option. But, of course, collars, very important strategy. We want to really spend some time getting into the nitty-gritty on how this strategy works. If you want to learn more about collars, I encourage you, of course, to surf on over to optionseducation.org. Alan and the guys over there have some great information for you, the busy advisor, on learning these strategies. Of course, you can also come to theoptionsinsider.com. We have a lot of great strategies and information and analysis for you over there as well. But before we wrap up the show, I'd like to check in with my various panelist cohorts here to see what they have coming up in their respective endeavors that may interest you, the advisor and asset manager. Maybe starting with you, Randy. I know you guys have a lot of stuff going on right now over at Swan Wealth Advisors. You just started launched the mutual fund. You have a lot of other stuff kind of in the works. So why don't you give our listeners a little bit of a rundown of all the things you have coming up that may interest them in the coming months?
Thank you. Yes, a couple of things that we're doing at our firm right now is, as you mentioned, we launched our mutual fund in August of this year. We think it's been very successful so far. We're really excited about it, and we still have our SMA program, which is kind of our bread and butter for people. But we think one of the best things about having the mutual fund is it takes away some of the limitations for people's IRAs and other retirement accounts that are normally limited. So we have a little more flexibility in what we can do in our strategy. We also just started a program this month with some other firms around the country where we're doing option overlay strategies, where we're offering our option expertise to hedge, whether it's a couple of stocks or a group of stocks or a single stock, or if you even like to do another type of strategy on the underlying, but still continuing our basic strategy of hedging the downside, as well as the monthly option income strategy with strangles and iron butterflies and calendars and stuff like that. So those are two new products that we've rolled out this year that we think there's a lot of upside potential with.
That's a good point, too. I mean, we talk here a lot about educating and arming the advisor to do this stuff themselves, but there are many times when either they're too busy, they have too many client accounts, or they just don't feel comfortable pulling that trigger with the option. So in that scenario, it might be worth it for them to contact someone like you, Randy, who can implement these strategies for them. So if they want to learn more about what you guys are doing, they should just visit swanwealthadvisors.com. And you could find out all the information about the mutual fund. I like the new website design too, Randy. It's looks good. I like it. So yeah, check out Swan Wealth Advisors if you want to learn more about what they have going on over there in Swan Land. But before we go, of course, Alan, you guys, last time we talked to you guys had just finished up the OIC Advisor Conference, and you were talking about upcoming initiatives. What do you have coming up for advisors that might be interesting in the coming months?
Well, we drew a lot of interest from our NYX Wealth Pension event in New York just a short while ago, and in fact, we'd like to repeat it in both Philadelphia and San Francisco. We'll likely shoot for a end of January repeat performance, this time not only inviting the wealth advisors as well as the pension managers in the region, but also reaching out to endowments, because we think that's an area that's been long neglected and probably is the one institutional segment that has really zero penetration with options. And we'd like to introduce these university faculty members and board members to the thought of using options to hedge the risk in their what can be very sizable portfolios.
An interesting and not very often commented on sub-segment of the market. So that'll be interesting to see how much uptake you guys get on the options information over there from that audience. I know I'm very interested in that as well, Alan. And of course, last but certainly not least, Mr. Cavanaugh, what is coming up in the land of KYO/RCM?
Yeah, a lot going on here. We're merging the two firms together. We're in the process of that. It's probably going to take another month or so, but 2013 is looking like the official change. I know this has nothing to do with my company, but we had the meeting last night of a non-related affiliate, basically the Options Alliance. And I know, Mark, you've put a lot of time in on the Options Alliance, but we really had a great meeting yesterday. The Options Alliance is a nonprofit that basically is an organization that was created to help bring the responsible use of options in the industry, and it's all industry participants, including advisors. So advisors listening to the show, I encourage you to reach out to Mark Longo through this radio network to find out more about the Options Alliance, because I think it's a really needed and necessary almost advocate group for the right usage of options, to gain an understanding if you're an advisor that's looking to gain an understanding from an educational aspect, or if you're a company or even an individual that's looking for the somewhat seal of approval of, hey, this person has experience and they've signed a code of ethics that says they'll represent options in the right capacity. So kudos to you, Mark, for getting the Options Alliance going. And I thought yesterday's meeting was great, and I would encourage everybody to at least check it out.
Well, thank you for that plug there, Mike. I didn't want to bring it up to toot my own horn, but it is indeed, I think, a great group. And we have added an advisor class based on a lot of the reception we received from that audience and that community looking to learn more about options and implementing options in a responsible fashion. So if you are interested in that industry group and looking to become active and learn more about what we're doing and what we have to offer and how we could help you use these products in a perhaps more effective and proper manner, then by all means, you can surf on over to theoptionsalliance.com or just optionsalliance.org. Either one will work, or you can even shoot me an email, mark@theoptionsinsider.com. I'll give you more information there. It is a great group that I think a lot of advisors will be interested in. And of course, if you're interested in giving us some feedback on this show, sending in some questions for the panelists here on the show, or just giving us some general commentary on the old advisors option, then by all means, you have a lot of ways you can do it. You can come to theoptionsinsider.com and use our comment system, or you can use that system to leave a comment on the site. You can send email feedback through that system as well. You can just send us a general email to questions@theoptionsinsider.com. I just ask you to put question for the advisors option in the subject line so we know which show you're referring to. Of course, you can find us on Twitter, twitter.com/options, or on Facebook. Let's search for Options Insider. There's a lot of ways you guys can reach out to us and become part of this show, and we encourage you to do so, because that's the reason we're doing this show, to help educate you, the advisor, and bring more of you guys into the fold to help use these products in a safe and responsible and proper manner. And on behalf of all of us here on the Advisors Option panel, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to our previous shows and making this show such a success. And we're very happy to be back and bringing you new episodes. So stay tuned and look forward to more episodes of the Advisors Option in the coming weeks.
The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.